Have you ever wondered about the performance of MGK versus VOO, two popular ETFs, but how do they stack up against each other? Let's kick things off by introducing these two heavyweights of the investing world. On one corner, we have the Vanguard Mega Cap Growth ETF, or MGK for short. With an expense ratio of just 0.07%, this fund offers exposure to some of the largest growth stocks in the U.S. market. It's a popular choice among those who are bullish about the prospects of large-cap growth stocks. On the other corner, we have the Vanguard S&P 500 ETF, otherwise known as VOO. This fund tracks the S&P 500 index, which comprises 500 of the largest U.S. companies. With an even lower expense ratio of 0.03%, it's a favorite among investors who want broad exposure to the U.S. stock market at a low cost. Both MGK and VOO have been popular choices among investors for their unique offerings. The former's focus on large-cap growth stocks can be enticing for those looking for potentially high returns, while the latter's broad market exposure can offer a degree of safety and diversification. However, it's important to remember that investing isn't just about chasing returns. Costs matter too. That's where the expense ratios come in. The lower the expense ratio, the less you'll lose to fees. That's why VOO, with its lower expense ratio, might be a more cost-effective choice for some investors. At the end of the video, we will discuss alternatives to both MGK and VOO that are better performers and have a lower expense ratio. So subscribe in the meantime. Now that we have a basic understanding of MGK and VOO, let's dig deeper into their performance. We started with an initial investment of $10,000. Let's see how they fared. In the blue corner, we have MGK, the Vanguard Mega Cap Growth ETF. It's been quite the heavyweight, turning that initial $10,000 into a whopping $39,304. That's nearly quadruple the original investment. It's been delivering punches with an annualized return, or CAGR, of 15.64%, but it's not all smooth sailing, as it has a standard deviation of 18.36%, meaning its returns can vary quite a bit. It's had its best year with a high-flying 51.67%, but also faced a tough year with a low of negative 33.59%. That's the maximum drawdown it's had to endure. And in the red corner, we have VOO, the Vanguard S&P 500 ETF. Starting from the same $10,000, it's managed to grow this to $30,323. That's more than a threefold increase. It's been packing a punch with an annualized return of 12.50%. With a slightly lower standard deviation of 15.63%, its returns are a bit more predictable. Its best year saw a solid gain of 31.35%, while its worst year took a hit of negative 18.19%. Its maximum drawdown has been slightly less severe than MGK's at negative 23.91%. Now, comparing these two financial gladiators, we see that both have had stellar years and challenging years. They've both managed to grow the initial $10,000 significantly, but MGK has pulled ahead with a higher end balance and annualized return. On the flip side, it's also seen a higher standard deviation and maximum drawdown, indicating a higher risk. Clearly, both ETFs have their highs and lows, but what does this mean for the average investor? Let's delve deeper in the next segment. Investing is all about balancing risk and reward. So how do MGK and VOO measure up? Well, let's talk about risk-adjusted returns. The Sharpe Ratio, which measures the average return earned in excess of the risk-free rate per unit of volatility, is slightly higher for MGK at 0.8 compared to VOO's 0.74. This implies that MGK might offer slightly better return prospects when considering the risk. On the other hand, the Sortino Ratio, which differentiates harmful volatility from total overall volatility by using the asset's standard deviation of negative portfolio returns, is also higher for MGK at 1.31 versus VOO's 1.14. This suggests that MGK might have a slight edge in providing better returns on the downside risk. And when it comes to benchmark correlation, VOO has a perfect score of 1, while MGK is slightly less correlated at 0.94. As we see, both ETFs offer different risk-reward profiles. It's all about what suits your investment strategy. So, after all the number crunching and analysis, where do we stand with MGK versus VOO? Well, it's a tale of two ETFs, each with its own strengths. MGK, the Vanguard Mega Cap Growth ETF, has shown a significant annualized return of 15.64%. It has a higher volatility as indicated by a standard deviation of 18.36%, but it also had the best year with a whopping 51.67% return. On the other hand, VEO, the Vanguard S&P 500 ETF, has a lower expense ratio and a benchmark correlation of 1, offering stability and cost effectiveness. Its annualized return is 12.5% with a lower standard deviation of 15.63%, meaning less volatility. Here are some good alternatives to VO. FXI has a lower expense ratio at 0.015%. The contenders for MGK would be FSPGX with an expense ratio of 0.035% or SCHG with an expense ratio of 0.04%. It's essential to align your choice with your investment goals and risk tolerance. Remember, the right choice between MGK and VEO depends on your investment strategy. Happy investing.